Hey guys, this is Rudy for Bester Investor. Today I'm not going to make a video about Occidental. My wife mentioned to me that I couldn't get away from Oxy even if I tried, which was around about the same time she told me to go and do the dishes. But anyway, what I thought I wanted to do today was spend a little bit of time just telling you how to exit some of these positions that you are invested in, and hopefully this will help a few of you to understand some of the tools that I use myself in my own investment portfolio account. So I'm specifically going to talk about trailing stop orders and very specifically sell orders. So in other words, I don't use trailing stops to buy, I use trailing stops to sell, and I'm going to explain how this works. It's a favorite of mine. I've used it for years, and I will keep using it. So let's take a look and see what this is. Just very briefly, there are a variety of different advanced order or stop order types. I'm not going to go into any of these in any detail whatsoever. Some of them are quite self-explanatory, like one order cancels the other. So as soon as one order is executed, the other one is canceled. If you place an OCO, a bracket is sort of an extension of that, where you can say the bracket order will immediately place a one cancels the other sell limit if you putting in a sell stop, or otherwise if you enter a short position, you can place an OCO buy limit with a buy stop if you want to take some profit. Most of you will probably be familiar with some form of stop limit orders where you can say I want to sell X stock at a particular price. If it hits that price, I want to execute the trade and exit my position. So these are just some others, but this is not really what I want to spend time on today. One thing that you need to be familiar with when you're using any type of orders that are automated is the difference between good till cancelled, which is very frequently abbreviated GTC, versus day orders. It's a durational order, and it simply means this order should be active. If I say it's good until I cancel it, it will remain active until the order is cancelled. Although GTC by definition means keep the order until I cancel it, the issuer can also cancel the order by instituting some kind of a corporate action, which could be, for instance, a distribution of dividends or warrants, or a stock split announcement or something of that nature. So if there's a corporate announcement from the issuer, even if you have a good till cancelled order sitting there, it will be cancelled, and your online brokerage will send you a note saying that your order was cancelled due to a corporate action. And then you can always create a new one if you wish to do so. So let's talk about trailing stop. So I use this, as I said at the beginning, as an exit plan, and I've used it frequently in the past in order to exit positions for a profit, and then I might open a position again, a new position in the same company that I just took some profit on. So I specifically use it when I have a stock that's trading in a profit zone for me. And as a sort of general guideline, when I get into a situation, and I'm fortunate enough, unlike my experience with Occidental recently, but when I get into a situation where my stock that I purchased, let's say for instance I bought JP Morgan at $100, and it gets up to $120, $130. So as soon as I get up into the sort of 20-30 percentile in terms of growth on my opening position, I look to plug in a trailing stop. And it's called trailing stop because effectively the stop order trails the stock higher or lower, and I'm going to show you how that works in a minute. So if it's trailing the stock higher, so as the stock is moving higher and higher and higher and higher, your stop order doesn't execute. But let's say for instance you put in a 3% stop order. As soon as JP Morgan were to drop, let's say even 5 or 10% in one day because they had a bad quarter, your order will execute and you'll sell out of your position and effectively take your profit. Of course, that would be a taxable profit, but that's okay because at least you exit the position with a profit. If, on the other hand, my position is negative and I'm riding it, like for instance, once again in the example of Oxy, I wouldn't plug in a trailing stop because then I'm just going to book a loss. I will book a loss if I have to, for instance, for tax purposes at the end of the year. but otherwise I would not necessarily execute any position at a loss. My philosophy there is I never want to take a loss. So here's an example of a JP Morgan stock chart, which kind of is a little bit more sophisticated than the little red line I drew just a minute ago. This is a graph of JP Morgan, and I chose JP Morgan specifically because the stock is trading at around $100, so it's easy for me to illustrate my point using percentages. It's very difficult for any investor to say like, oh, I bought the stock right at the bottom. And anyway, even if you did, you're going to hit another bottom again, or there's going to be a new bottom, or there's going to be a crash like we had in March. So from a timing point of view, you cannot do that. However, it is very possible to buy JP Morgan at any particular date. And when you purchase the stock of the issuer, over time, there's a really good chance that it may go up in value. So as you can see in this chart here, you have dips and peaks and valleys and all kinds of things as you normally do in any stock chart. So effectively, let's say I purchased the stock, and let me just clean this up a little bit so that I can maybe make some different markings for you just to illustrate my point. Nobody can time the market, so I'm going to assume that I cannot and you cannot either when I say nobody. So let's say I bought JP Morgan sort of around about here. If I purchased the stock and looking at my graph over here, I might have opened this position at, let's say, $90. And when I opened the position, I did nothing. And I did nothing for quite some time. So I, in other words, just watched the stock. And JP Morgan went up and down and up and down and up and down. And then somewhere along the line, I plugged in a trailing stop of 3%. And I said, as soon as the stock were to decline, remember I'm using the trailing stop as a sell order. If as soon as JP Morgan goes down 3%, I want to exit my position. So let's assume, just for the sake of my illustration, that I owned JP Morgan during this period when it had a nice big run up all the way to about $130. And I had a 3% trailing stop loss order plugged in. When that trailing stop would trigger would be any time when JP Morgan went down by 3%, which obviously very much would have been likely when we saw this big drop in March. So I'm using 3% as an example, but it could even be a 10% trailing stop if I have a very nice profit situation on the stock. So as soon as JP Morgan in my example dropped by 3%, my order executed, and when that trade execution happened, I exited the position entirely using the trailing stop to mitigate my further losses and to book my profits. So I'm going to show you on the next slide what a trailing stop order looks like, and then we'll wrap it up. So this is an actual example of a trailing stop order, and as I said, I'm using JP Morgan as my example. So here you can see JP Morgan was trading in a range of about $100. I booked or placed a sell order for 1,000 shares of JP Morgan with a trailing stop percentage, I can also use dollars if I wanted to, of 3%. And I marked it good till canceled. In other words, this order will sit there until I cancel it or until JP Morgan says we're having a stock split, or we've just issued a dividend payment, in which case the brokerage online brokerage account will notify me that my trailing stop order has been cancelled due to a corporate action. But in this example, I plugged in a trailing stop order for 1,000 shares of JP Morgan at 3%. This order will sit there being good till cancelled for the next however long before there's a corporate action or before I cancel it. So let's say 90 days or 180 days or whatever the case might be. And as soon as JP Morgan stock drops 3%, I will exit the position and book my profit. So using my earlier example, because it's a real example, JP Morgan is at about $100. This is as of today. If JP Morgan went up to $130, and just to make an easy number or an easy calculation for me to illustrate my point, let's say I plugged in a trailing stop loss of 10%. So 10% of 130 would be $13. So JP Morgan crashed along with all the other stocks in March. And from $130 per share, it lost $13 in value, taking it down to $117 per share based on my trailing stop of 10%. As soon as JP Morgan went from $130 per share to $117 per share, my trade executed at $117 per share. And because I bought the stock for $100, I make a $17 profit, 17% profit per share, and I exit the position. I have a $17 gain that is taxable, and I can buy JP Morgan again on the way down, or otherwise I can say, thanks JP Morgan, I'll book the 17% gain, and I'll look to see if I can buy something else that might be horribly undervalued, like Wells Fargo. So in closing, if you find yourself pulling out your hair, trying to figure out how the stock market works, when a stock goes down, you basically have three choices. You can either do nothing, or otherwise you can buy some more, or otherwise you can sell at a loss. So using a trailing stop actually is something that I plug into any investment position where I have a nice gain. It mitigates my risk, and it helps me to book profit along the way, and I can always purchase and open a new position in that stock again. So I hope this helps you a little bit. This is Rudy for Best Investor signing off. If you like my video, subscribe, and I will see you later with a new one. Bye-bye.